bring on board then Chandresh Nigam from Axis AMC to talk about his market opinion. Chandresh, good morning. Good to have you with us in the studio. And clearly the market seems to be just biding time for the next big event, which is going to be the RBI policy.
Yeah, I think the market is in no man's land right now in some sense. I think there is significant concern emanating largely from the global markets. Foreign investors, if you speak to them, I think we've seen what they've been doing over the last month or so, which is taking money out largely. The scare from China, which is going to have a big impact on global growth. As we all know, last 3 or 4 years, China has been the big driver of the global economy, not only in just of growth, but also in terms of supporting prices, commodity prices, and general levels of prices. The worry is that there is going to be, there could be a big scare on deflation globally, and that is not good for any markets, and in fact, many of the developing markets especially. And that concern is making investors actually take out a lot of money away from emerging markets, and India has been then, in that sense, caught in the crossfire. So when you have $1 trillion moving out of the emerging markets, obviously we've seen some significant outflows from our markets as well. And that scenario doesn't look like changing in the immediate term. Obviously, that will take some more time and will change only if the data out of China stabilizes, and we do see some significant growth coming back into the economy. So it's an uncertain situation, and in which case we can't expect to see any major support from the foreign investors, and until that happens, I think our markets will remain, as I said, in a range with no clear direction.
But till when are we going to be directionless? You may even see clarity from the US Fed in its next policy meet, but you're not going to see any clarity coming from China, because even the data that they dish out is sort of unbelievable.
Yeah, I think so. I think the problem is that only, that I don't think it's as much about the Fed. I think the Fed is ultimately going to be looking at China, as they said in their policy as well. Why they didn't say specifically China, they did
October, December 2016, whenever.
Yeah, so while they didn't specifically say China, they did say about, they are worried about the global events and what's the news flow coming out. So eventually it is going to be China, I think, and China will take time. There is no clear answer. And that's why the uncertainty is a lot longer. So when you look at people making allocations or starting to look at what happens in 2016 now, there is really a haze as to what people will do from an emerging markets perspective. So I'm afraid we don't have an answer there. But from an India perspective, I think unless the flows continue to be very large in terms of outflows from the emerging markets, I think from an economy perspective, we are reasonably well placed. I mean, that is very clearly laid out that of the 15 emerging markets, India is the best place to be for the next 3 or 5 years. I think that's something which is very clearly etched in the minds of investors, so that we will be beneficiaries of. So there will be these bouts of large flows, outflows, in which case we will see volatility on the downside, and then we will see support, as investors anyway think India is a great place to be for the next 3 to 5 years.
The DII flows have been robust till now. The fear, if at all, is that assuming that FIs continue to be in this undecided territory and continue to pull money out, and if the DII flows stop, then that's the bigger worry. Now, to your mind, can that happen? Because until now, because of the new government and the hopes of an economic turnaround, people have been putting in money in droves in SIPs. Do you think that could change?
So, I mean, at a level, yes, I would agree that the general sentiment in the market and the levels in the market and the short-term moves in the market drives the flows in that sense. But as you said, large part of the flows are from SIP. So those are, we've not seen those, stopping immediately. Yeah, if you have a long-term slump, then many of them get discontinued. See, our sense, what we are seeing in the markets is that as markets fall, more people are wanting to come in. To be fair, over the last, let's say 2 years, when this rally started, actually August and September of 2013, not very many people have been able to participate. Most of the money started to come through, say, about 12 months back. So there's still a large pool of money waiting to come in. 2 other very important things. I think you look at the structure of financial savings, or let's say total savings in the economy, the real savings, which was basically in real estate and gold. I think both these asset classes have turned negative. I mean, certainly from a last 12 months or 24 months perspective. So that is leading to more money coming into financial assets, and equity markets in that sense will be beneficiaries of that.
what within equity markets then? So we've established the point that what will drive the markets if they have to be driven. The other facet that will drive the markets would be delivery of earnings in addition to reforms, and we can keep on arguing about that, so on and so forth. But let's talk about the delivery of earnings. The upcoming earnings season, most people believe will be a washout. Probably hopes only pinned in the Jan quarter. Do you, by virtue of whatever you've researched, believe that there could be an earnings recovery anytime soon enough?
Okay, so this is going to be a little long answer, so just bear with me on that.
Fine, no problem.
See, if you start to look at slightly from the global perspective, I think one thing, if there is going to be a deflationary scare, then many of our Indian companies are actually not going to be able to see any meaningful recovery. Meaningful in the sense structural longer term recovery over the next couple of years. So I think one part of the market, I think, gets affected on a long term basis. What we are looking at is that there are those quality of companies which call as higher quality businesses, which have pricing power, and they are actually very big beneficiaries of whatever is happening globally, whether lower oil prices, commodity prices, input prices, etc. You look at the autos, you look at some of the consumer companies. So I think even in the last, let's say, couple of quarters, these companies have continued to do well. So overall, the corporate profit growth numbers may look reasonably, and I think they will be quite tepid over the next 2 or 3 quarters, but you will find pockets of very strong strength, and which we will say is basically the high quality businesses, companies which can drive reasonable growth even in slower growth global economic scenario times. Those are the businesses which will continue to do well. Now all this can change, and in this whole specter of slow global economic growth, if we can then turn around, as you said, things like policies and get the domestic capex cycle really going, then we can get that, we always say, tide lifting all boats, but that tide is not visible today. So if all those happens, and that is a big if, yes, there are some positive pointers to that, but if we get that tide, then yes, you will see a lot of cyclicals and other smaller businesses, more economy sensitive businesses starting to do well. But as of now, the way things look like, I think we are betting on high quality businesses growing 15-18%, having a margin kicker because pricing power and lower commodity prices. I think that's the place to be. And frankly, I mean, if overall earnings growth remains tepid, but if your portfolio companies can keep growing, I think that should continue to do well.
So which are
so
the
not
sectors?
A very positive answer to what you might be looking for.
No, we look for realistic answers. Yes, it's much better to get that.
And more specific answers at that without talking stocks. But tell us which sectors are you reiterating to? Where do you think
I think
visible?
the great story of India, and I've said it earlier on your channel as well, is I think the great story of India, and we all should feel blessed that we have access to such a great market, is that you have a number of companies across sectors. I mean, where you will find this characteristic of companies having built up very strong competitive advantages and hence get pricing power. I think quality in a nutshell at the end of it means that they should be able to charge a price which allows them to have reasonable ROEs. And then growth is anyway there. I mean, whether we grow at 6% or we grow at 8%, I think many of these businesses will see reasonable growth. So they are there across. I mean, they are in consumers, they are in autos, but it's not as if that a sector has, all the companies have pricing power. There are only a few of them. But I think in the market, when we have about 1,000 plus stocks which are traded on a daily basis, there are about 150, 200 such businesses. And that's why I say that there is a lot of opportunity from a stock picker's perspective. So without saying what sectors, I mean, they're virtually there everywhere. I mean, even in real estate, you will find them, sectors which sometimes people have not really liked it that much, but there will be pockets or maybe some smaller businesses which will be available across sectors.
Okay, let me try and rephrase that question as well. Are there any beaten down spaces? I mean, for example, even though they're good companies, if metals are underperforming, all of those go down. So you may selectively want to pick, but the tide is just so not in your favor that you can't pick. So are there sectors wherein the tide could turn around over the next 12 months?
So I think global commodities is something which may have some kind of a bounce, but that's not, I don't think it's an investable, it may be a tradable bounce, but not an investable bounce. Because if you are worried about deflationary conditions, it's not for 2 years or 3 years, could be longer. So I think they will remain under pressure. The sector where I think some I don't think actually there's any beaten down sector as such. I mean, people are certainly looking at things like capital goods, for example. It's not as if that they are beaten down anymore. I think the quality companies in that sector have also picked up. But yes, if the construction and capital goods sector and let's say the capex demand in the economy really picks up, that is one sector which will see, I think, large number of companies being able to participate, because the fact is that the demand for this could be very, very large. Demand for build out of infrastructure, etc., could be very large, and many stocks, when there aren't too many quality businesses, and in which case many of these businesses will see very strong growth in order books, etc. And which
the larger ones, right?
Even the smaller ones, it will percolate down, because it's not few companies can't do all this.
Yeah.
But yes, it's still some time away. We don't see, while we are seeing order books pick up. In fact, if you see the last 3 or 4 quarters, the order books of many of these companies have picked up nicely. But we need to see some faster and more stronger growth in order book to see that they can next couple of years really do very well.
How do you approach autos? Because that's emerging as such a varied sector with such a company-specific dynamics playing out. A Tata Motors hitting fresh 52-week lows, a Maruti, which is the favorite of just about anyone on the street.
So you just look at pricing power. Those who have pricing power, the tide is in their favor. I think that's where we are, unfortunately, going to stay in a reasonably low growth scenario. We are not talking about the 8% plus kind of growth scenario. In which case, the people who've done the innovation, who've connected with the customer better, who and hence at the end of the day have market share and pricing power.
But isn't that an overcrowded trade?
It is, and in fact many of these businesses are reasonably, in a PE terms, highly priced. But one thing which we have seen over the last, I mean, you can see 10 years data and 20 years data, these are the businesses which create wealth long term. I mean, the question which I am most often asked is value versus growth. I think growth has beaten value hands down in this. I mean, the way the data comes out is if you don't have growth, value just cannot perform. I mean, if you have in a growth stock great value, then that's the best place to be. Unfortunately, that's not available anymore.
It's called luck.
It was available 15 months or 18 months ago. Today, it probably does not exist. So in this scenario, do you want to go for value which may not be in such a great quality business, or you want to grow pure growth, maybe pay higher? And we would think the way the global economy is poised, and certainly it will have ramifications on Indian companies as well. I mean, we all come out and say that India is relatively insulated, which is true, but some of these commodity-like businesses where import substitution is easy, where customer connect is not that high, I think they will get affected. So in which case we would continue to back high quality business. They may be trifle expensive, that's fine, but if you have a 3 to 5 year view, I think they will do phenomenally well.
Okay. Final thought, question from mine at least. You know, typically when people either write blue sky reports or write obituaries, as the case may be, to my mind, a lot of times it signals a top or a bottom. Now, very recently with crude at 40-42, there was almost an obituary written saying that crude could well head down to 20 as well. Yeah. And so my question to you is that could there be a possibility, not because of that report, I mean, I'm just using that as an example, but is there a possibility of oil bouncing back over the next 12 odd months as well? Because again, global growth is not there, but because of reasons other than just growth, oil may have a tendency to bounce back as well. Could that happen? And therefore, would some of the oil and gas names which are languishing, so to say, have, I mean, I'm excluding the OMCs out here.
That's the toughest question you could have asked, because oil nobody has been able to predict, and that's why you are seeing reports which are of $20 oil and also $80 at the same day. I mean, you can, and from the same publication, in fact, in that sense. I'm not talking about the research agency, I'm saying people who are reporting that. So I think it is an extremely difficult call. It's dependent on actions of so many players in the industry, and as we all know, the price is set by the marginal producer, and there are so many of these marginal producers all over the world. I think if you were to look at a very comprehensive study and look at, say, where are the real cost curves lying, and behaviorally what people should be doing, then we are reasonably sure that prices medium term have to go up. I think it can't be down. It may go down for technical reasons, people just pumping out, or just the fact that closing out fields or shutting production is more expensive than actually continuing production. So in which case, but I don't know. I have no ways to say that it will go down. But yes, I think over a 2, 3, 4 year perspective, I believe the global economy will still be dependent on oil. Yes, there is this whole issue about renewables, but that I think is a slightly longer term play. It looks like oil will be higher over a 3, 4 year period. Will it be materially higher? Difficult to call, but the cost curves are saying it should be around $70. Now that's a fundamental basis, may not be always true.
Yeah.
But if that is the case, then yes, I mean, one could start to look at those businesses. But my perspective is, when you have anyway 200 other great quality businesses, why do you want to really try your luck on those, which is anyway very, very difficult to
guesstimate,
to forecast. Yes.
Yeah. So just in the near term, our own dynamics, how imperative and how big a game changer is the RBI policy? If a 25 bips cut comes, would that really please the market and change the direction in the near term?
I think many of these things, like the Fed in that, I think we always getting swayed too much on these things. I don't think it really matters too much. I think the important thing, which I think in fact the RBI has been saying, is to get the structural reform in place, address the supply side of the equation, get the banks in a position to be lending higher. I mean, the risk appetite of banks today is not that much, as we all know. I mean, these are more important issues. Yes, a lower interest rate will certainly have an impact, but does it really fire the economy really materially? I really doubt. On the other hand, also what you need to see is the profitability of the banking system is anyway under stress, under question. And you have all these on the liability side, which is place where the banks raise resources. I mean, this whole case in point about newer tax-free bonds issuances. I think I doubt if the banks can immediately materially bring down their cost of deposits because of competition. So I think we are in a zone where if you look at it just as a signaling mechanism, it will be a signal, and then that story will be over in a two days or 2 weeks or whatever you may call it. But long term, will it have a major impact? I doubt. I think the long term impact will come only when we see the RBI guiding that, hey, rates are going to go down materially lower, which I don't think they are going to guide right now. And they are going to stay there because inflationary expectations have been curbed, etc., which I don't think has really happened in the economy. So it's a yes, we do it. So as a fund house, we do believe that there could be 75 basis points kind of cut over the next 18 months, but that's contingent on a number of things. And let's see, we'll have to wait and watch. I doubt if suddenly business people and business confidence will suddenly shoot up because RBI has cut 25 basis points.
And the US Fed continues to be an overhang regardless of whatever.
The US Fed, I think the fact that they have now started looking at the global scenario, I think while they may still do a token 25 basis points, I think their ability to be able to move is going to be very limited this year and even next year. And I think it is in some sense an admission of the fact that we are indeed having a major crisis of growth in the global economy.
Okay, good chatting with you, Chandresh. Thanks much for taking the time out and speaking with us today.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.